B. Prasanna, Group Head, Global Markets with ICICI Bank joins us now. Prasanna, one side markets are worried about slowdown, and what I've learned over the years from folks like you who understand economy much more is that if there is fear of recession, then bond yield should come down. If there is fear of inflation, bond yield should go higher. So equity markets are falling. Why? Because there is fear of slowdown. Bond markets are rallying. Why? Because there is fear of inflation. How can both these fear coexist?
So I think the problem with this correlation analysis of the past.
It's a right question. First, tell me it's a right
I think it is a right question, except that it's possibly more relevant from a global perspective, Nikunj. So let me just explain for a minute. So I think what typically happens when there is a recessionary kind of tendency is for people to believe that bond yields will fall because you go from the safety to the safety of bonds away from risk assets like equities. But however, what has happened over the last, say, 2 weeks or so is the kind of volatility that has been created by policy making in the US has kind of led to lack of confidence in the institutional mechanism in the US, lack of confidence in what's going to happen in terms of future policy making. The uncertainty premium has shot up, and people basically don't want to. I'm talking about global investors, don't want to kind of invest in dollar assets as much as what they wanted to invest earlier. So what is happening here is that, and also bear in mind that tariffs have a stagflationary impact where you have a lower growth, but you don't have a lower inflation, but a higher inflation. But the argument was that the higher inflation was going to be transitory, it's going to be one time. And so central banks might look through it and hence might cut rates if they really fear lower growth. But what has happened also is that there seems to be a lot of selling by global investors in US bonds, basically due to a lot of geopolitical reasons, as well as due to fear of the dollar, whether how it's going to behave going forward. So in this kind of a scenario, when uncertainty is so high, past correlations typically tend to get broken. And that's the reason you're seeing in the equity, in the US markets, equity market as well as bonds, both falling at the same time. But if you look at India, for example, I think I would say that bonds have been pretty well behaved even when equities have been falling here. I wouldn't say that this kind of a negative correlation between the two markets in India will last forever. There are times when strong equity means strong inflows, and strong inflows means bond flow. It's also good for bonds. And so bond yields can also fall. But I think right now what's happened is you've got an RBI policy which is so positive from a trajectory perspective on rates, that market is taking heart from that. And if US bonds were not as volatile, or global bonds were not as volatile and had not gone up, yields had not gone up, you would have seen much bigger fall in Indian bond yields than what we saw on Wednesday when the policy was announced.
So can Indian bond markets and global bond markets move differently? Which is that in US bond yields could move towards 5%. In India, they could go below 6% or could near 6%. Can these both parallels coexist in this global environment?
Yeah, so great question, Nikunj. I don't think that's really possible, because it requires a great heart and a real courage to, come and keep buying bonds here when, bonds are falling elsewhere. So that's why I said that it's very possible that we will react much less. That's the first thing. So obviously, like I said, if things were fine in the global bond market, we would have seen a 10 bip fall in yields, but we fell only 3 or 4 bips. And like you said, if it continues and if US bond yields were to go towards 5%, which is not a very outrageous kind of an expectation, there is definitely a probability associated with this because of the kind of geopolitical selling that we are probably witnessing in the global market. If that were to happen, then I'm afraid that Indian bond yields will also kind of, go up in the short term. But the saving grace is that if US bond yields were to go towards 5, number one, Fed and his Treasury Secretary have clearly said that they're watching bond yields very closely. They will reverse policies to ensure that they try to bring bond yields lower. And second is, if it were to go towards 5, you can see the Fed using financial stability as a very important reason and put it on top of inflation. Today, if you were to put inflation and growth, they're probably putting it on equal weightage. Financial stability is not really coming into play. But if bond yields were to go up to 5% in a scenario where recession is also likely to come, then that clearly means there's a dislocation in market and the Fed can finally, change tack. So the saving grace is that if bond yields do go to 5, it's quite possible that the Fed will, react a little differently than what they have said they will react in the most recent policy. They have said that they're going to wait, they're going to worry about inflation and all that, but that can change if bond yields go up. So while the path towards 5 can be very rough and very bad for global bonds as well as for little bit for India, the path after can get better because Fed will also have changed tack and RBI has already changed its stance and given you a reasonably dovish trajectory going forward.
Okay. Now I'll look at India, only India, which is interest rates have come down, government spending is normalizing, and liquidity has increased in the system. So the fear in the market is that because of tariff, there is going to be an engineered slowdown and it will hit us either in this quarter or in coming 2 or 3 quarters. But given that macros are getting better, rates are coming down, liquidity is coming back into the system, can this perceived global tariff impact, will that hit us or that will get averted because of better Indian macros?
So again, a very similar answer to the earlier question on bond markets. It will hit us, but it will hit us much less than what it is hitting other geographies and other locations. So our house view is, for example, for a cut in GDP to the extent of 20 to 30 basis points in FY26 for the impact of the kind of tariffs that was put on us. And also bear in mind, by the way, that we really don't know what is the level at which tariffs are going to settle. He has bought time for 90 days, but whether he's going to meaningfully get into any deals and then relax it. What's happened over the last 2 days, I would say, is again a little bit incrementally positive because it is getting more negative for China and less negative for countries like, India. And it's quite fathomable that Indian external affairs policy can also work this way around to ensure that the kind of trade deficit that we have with the US is minimized, in which case you can get away with much lower reciprocal tariffs than otherwise. But all in all, I think there is a lot of uncertainty which has come into global markets, global economy. And uncertainty always means higher uncertainty premia, which in turn means higher cost of capital in general. And it means investment plans are not going to be announced and executed in the same way and pace at which it was earlier executed. Obviously, CEOs of global companies as well as Indian companies will now think doubly, think triply whether they need to expand at this point of time or whether they want to wait and see which way the tariff is heading. And also, if US is impacted, India will also get impacted through some of the sectors which are linked to them through, say, IT or pharma and things like that. So I think net-net, there will be an impact. It will be a much lesser impact than what some of the other countries will face.
Okay, Prasanna, so good having you on the show. Thanks for your time, as always.
If you like this video, then like, share and subscribe to ET Now.